in rooting and contributing to being on the racetrack of the transmission channel of monetary policies, the role that they have in activating these monetary policy signals. And the scheme was very simple, and it's described by the scheme, and particularly we saw yesterday. So now, this evening, I would say you something more about that, and specifically about the monetary function, and then about the core differences between banks and insurers as first. So the question to start this issue of functions of banks and commercial banks, we'll see tomorrow, not tomorrow, day after tomorrow, we'll see how many, maybe even this evening, which are the main kinds of depository institutions, so commercial banks and the others, at least in the United States, but you know they more or less the same. We may apply the same taxonomy, whatever was the country. And the question I was telling, the question, the starting question would be why we need banks and insurers. I already told you something yesterday or the day before because today is Wednesday, so last week probably or yesterday. I told you, well, banks do exist and insurers as well, because we could say, by simplifying a lot, no banks, no business, and no insurers, no safe business. Because in case you cannot insure your risks, you cannot cover the risks, pure risks, and especially huge risks you are exposed to as an entrepreneur. In case you cannot cover, you cannot afford that you don't cover, so you cannot, if there is no possibility to insure them, these risks, well, you cannot count on a long life for your enterprise, because you'll probably fail in a short time. Because you know, you can fail every day because of whatever accident, even just even if a worker, unfortunately, it happens, and not so. That's not so rare that the worker would die and you have to pay and you have to refund the family. And of course, it's not your responsibility. If you are not insured, not necessarily, it's your responsibility as an entrepreneur. If you had to refund, you probably, a small enterprise, they couldn't afford that. So, no banks, no business, no insurers, no safe business. No banks, no business. Why? Because the enterprises, which are the most important category of borrowers, well, they need money. Usually they have. That's what we call the capital, the internal source. Because we should distinguish, and you know the story from the first year probably of your studies. We have to distinguish between internal sources and external ones. And internal is your own capital, and the external are the money you collect by issuing bonds, so lended money or you collect from the banks as well, lending activity more and more, or the money you collect as capital if the capital is a shared capital, so bigger enterprise. So you need money as an entrepreneur, and your own money will not be enough. I mean, the capital, even if you have capital, you cannot manage. Looking at the financial theory, uh, this debate about why banks do exist and why insurers do exist has been on the top of things for several decades, many years. And we may distinguish three different approaches in subsequent. So the oldest was the money view. Then the credit view, and then the asymmetric information view. So there are three different approaches. According to the money view, the main function, which is still one of the functions which is universally recognized to banks, but the main function, according to this old approach, which is also new as the old view, the banks do exist because of their monetary function. So because of their attitude to contributing to the money circulation, because they provide money, and from your background, you know that they are in the middle. In fact, the function we were referring before to, so the monetary policy can be activated through banks because banks they receive high potential, so-called high potential monetary basis from the central bank, and then they lend this money to the market several times because it's going out and out as many as is needed, as is allowed by the percentage they had to reserve. So according to this view, the most important function is this attitude. So now I would like to ask you, is still like this or not? So are the banks the only actor that we may uh, imagine playing this role nowadays, or is no more like this? We are speaking about of the dominant view 50 and more, 60 years ago. So several decades ago. That was the first approach in the literature, I mean. Well, of course, nowadays you don't pay anymore with checks or with bank transfer. Well, maybe occasionally bank transfer, sure, but that's not exactly uh, a privilege of banks to contribute to circulation of money. What I mean that there's so many more than in the past. So many ways, so many kinds of payments that you can perform without banks. Just think about the plastic money, so credit, debit and credit cards, so the prepaid cards. Think about the phone banking. Think about the, well, phone banking is obsolete. Think about internet banking. Think about the apps you have on your mobile to pay. Think about the fintech facilities. Think about, for instance, even the most famous and at least worldwide used China, for instance, in China, no, how many people they live there. WeChat, you know what is WeChat? WeChat. WeChat is something like WhatsApp, and this is a way that they pay everything there. Everything you can pay with mobile, just by framing a QR and you pay. So it's no more the reason why we need a bank. This one. If it was just because of that, we could skip. We could kick off banks from the market. Then we had the credit view. Credit view. And what is a credit view? The credit view says what it says. According to this approach, the banks do exist because of their attitude to repackage the assets on the asset side. In fact, so the loans repackage these assets. So the risks they assume, they subscribe, they underwrite on the asset side in order to change both maturity and risk of those assets. This is what we call maturity transformation and risk transformation. And again, what I mean that this assets, this risky and long-lasting, long maturity assets on the asset side are underwritten by bank. They are repackaged and let's say sold, but it's not like this, not exactly like this. They are sold to the depositors as certificates that they are short term, have a very short maturity, even spot, and free risk. So this is the risk transformation. You have a risk, you have a risk of borrowers on the asset side, and you give to the depositors the possibility to buy free risk activities, assets for them, of course, liabilities for you. Or in the opposite direction, you collect money and then you lend this money. You are in the middle. This is what is called the non-direct credit, which is direct credit. Direct credit is when the investors, not the depositors in this case, but investors, they change their head. Investors buy bonds so that they give this money directly to the banks. And that was the credit view. Credit view says that the banks do exist because of maturity and risk transformation they perform. Later, that was, I told you, they are subsequent. So later means since maybe a couple of decades till now. The asymmetric information view developed And what is this? What it says, the asymmetric information view? The asymmetric information view says that banks do exist because they are the only actor capable to face asymmetric information between lenders, whatever kind of, and borrowers. Which means that they can manage to lend, they can manage to select the best borrowers in a proper way. And in fact, if you think about that, you'll easily realize that as an individual buying bonds, you have no chances to make an effective, not necessarily, at least not necessarily, a fruitful, a profitable investment, because you don't have probably, again, not necessarily, but probably you don't have experience, or you don't have technologies, you don't have competence, or again, at least you don't have all the experience, all the technologies, and all the competencies a bank could have instead. And more, you don't have the budget. I mean, you have some money to invest, but you don't have the budget as a bank, which can diversify, of course, as so reduce risk dramatically. Yeah, sure. Yeah. Well, publicly available data are not enough. I mean, you cannot decide which is the best. Even if you look at the ratings, you cannot be sure, speaking about risk, of course, you cannot be sure that your choice is the best one. So you need, for instance, in a bank, you'll find Bloomberg data stream, you'll find Reuters, you'll find a series of facilities, technological facilities. Then you'll find uh, people having a long lasting experience as buyers, as traders, and then you find, therefore, competencies to make a proper choice. And according to this, also they will be able to recognize when the entrepreneur, when the borrower is coming with fake information. So having made up this balance sheet, making that, having, adjusted information in order to show himself as having a better merit than he has in reality. So that's the reason. That's not a matter it's not just a matter of collecting information and difficulty that you could experience in collecting information by yourself. You can read newspapers, of course, and specialized journals or periodicals, but that's not enough. Not enough for sure. And so that would be the reason, according to this third approach. This is the new view. So old view, new view, and this is also new in some sense. It depends. It depends on where you fix the boundary. Now let's switch to insurers. So to another kind of intermediary. What kind of? Well, an intermediary which is relatively far from bank. I mean, because of its peculiarities. So I am asking, could we apply to the insurers this perspective? Could we say, in other words, could we say that the insurers, they do contribute to circulation money? They have any role? No. Insurers. What about credit view? Could we say that the insurers do exist because they lend money? Sorry? No. Well, we should say a few words on that because actually insurers do lend money in very specific occasions because you know more or less and you'll be aware later on, much more aware of how it works. But I mean, with the insurance business, when insurers collect money from the market through the policies, from the policy holders, through the premiums, because they pay to buy policies, they are liabilities for you because you know you are signing as an insurer, you are signing a contract where it said that if in future anything would happen, I mean the bad outcome of a risk, you should pay, you should refund, let's say refund these people. So this is a debt, but this is an aleatory debt, as we did specify, already specified in the past. Yes. So this is the nature of the relation between the insurer and the policyholder. They collect this money on one hand. They lend this money. No, they are not lending this money on the well. They are not borrowers. So who are these people playing the role of the borrowers? They are the policyholders themselves, because in some specific case, you may obtain from the insurer that you can use temporarily, you can use the provisions that the insurer has to constitute in its balance sheet with your name and surname. So if Maurizio would buy an insurance policy, a life insurance policy, and if I start paying my premiums to the insurer has to save a big portion of these premiums, trimester by trimester, or year by year, or every 6 months I pay, and they have to save a big portion of this premium as a provision for precautionary reasons. Okay? So after 2 years, 3 years, 4 years, because the contract will be 10 years, 15 or 20 years even, for younger people than me, there will be quite a significant provision corresponding to my contract on the liability side of the insurer. And I could ask the insurer to use this money paying a commission. That's a loan. That's technically a loan. But this is not the mission of the insurer. This is just a collateral activity. And so it cannot be the reason why of insurance for sure. So the only, no, again, the only remaining reason is the capability that insurers have to manage asymmetric information. You know, this is just theory, we'll see that there are many reasons, and the most important is that the one I already told you before. So no insurance, no safe business. So the insurance that don't exist because they guarantee the survival of enterprises. But still, they couldn't guarantee anything if they were not able to control asymmetric information. And asymmetric information is not on the asset side, this side, but it's on the liability side, so with the policy holders. So let's say that this cannot be applied to the insurers, this cannot be applied to the insurers, and this can be partially applied to the insurers. Now, looking at the differences between banks and insurers, as I promised it, well, the first one and most important is that core risk So what I'm going to write down now, it stands for banks. Then we'll see what happens in case of insurance. In case of banks, core risks is located, let's say, on the asset side. This is a meaning. No, it doesn't make too much sense like this because the risk is not located. What I mean that it's depending on the assets. The core risk is depending on assets, and assets are loans, of course. This is the first peculiarity of banks, and not just the banks, but banks for sure. Then the second one, help me. Well, there are many, at least 5, 6, 7. For instance, I told you about the attitudes, and their attitudes, well, they have, I told experience, they have. They have. I told experience, technologies, and what else? Competence, which is a consequence of experience. For doing what? To perform the portfolio, the loans portfolio management, which means to replicate, to transform risks and maturities for, let's say, repackaging assets, which means transform transformation, and you know what transformation, transformational risk and transformation of maturities. Then, what else? They have budget, they have enough budget to diversify, so they can diversify. What kind of diversification? This is diversification, you know, not all, no bank should lend all its money to a single borrower. We saw this, and this was the was very intuitive. Not all your eggs in the same basket. That was the diversification by subdividing. Then, what else? The profile you were referring before, so the informational profile. So where to find information? Are information free of charge? Are publicly available, or I have to pay? You have to pay probably. You have to pay, but in many cases there will be fixed costs. So the higher is your budget, the lower is the incidence of this costs on portfolio, on the individual contracts. So the low this is a list of characteristics, peculiarities of abilities of banks or benefits they can enjoy. Low incidence of information costs on individual loans. What else? Right inside here is a credit function, the monetary function, so, not explicitly. They have the ability to manage asymmetric information. They can manage asymmetric information. All this and other, let's stop here. All these can be summarized by saying that they or at least all these activities, all these attitudes are aimed. The goal of all this is to reduce risk. For depositors. So for the prototypical clients on the liability side. This was for banks. Let's see for insurers now. And let's apply the same logical scheme. So before it was the core risk is located on the asset side. Here, the core risk, which is the subscription risk. Before it was the credit risk. Now the subscription risk, which is the core risk, is located on liability side. Because it's depending on the accuracy of the estimations that I made as an insurer. I made of losses and probability. So the expected loss will be depending on what? On how I built the portfolios on the liability side. Then the second one here was experience, technologies, and competence. Well, they have also as well. They have experience, technology, and competence. For doing what? To perform pooling and portfolio risk management. But what is most important is that here experience is crucial. But of course, both banks and insurers, they need experience, technology, and competence, of course, of course. All intermediaries, all financial institutions. The governance of these financial institutions needs experience, technology, and competence. But why I am emphasizing this experience? Because experience is everything in case of insurance. It's because of the experience that you can better evaluate the risk. You can better estimate the value of L, loss, and the value of P, probability, for each of the contracts. It's only because it's only as a consequence of a long experience that you can apply the law of large number. Law of large number, so many trials, and trials is what's happened in the past to refine your estimation. Then, what was before, the third one was they diversify. Do they diversify? Yes, they diversify. And now it's that's the pooling, so the by adding diversification. They diversify by adding. Then it was the information costs, and the same like before. They benefit from low incidence of costs or fixed costs, let's say. Then was asymmetric information. Yes, asymmetric information. They can manage asymmetric information. And so on. I think it was the last one in our result. So there are some differences, some strong differences. The first one for sure, the second one for sure, they are doing two different things. The second is the mission. And the first one is the core characteristic of the balance sheet. Well, the third one is also, but there are two different sides of the same coin. And then fourth and fifth, they more or less are the same. But all these, before it was, the goal was to, you remember, which was before? Reduced risk to the benefit of depositors, okay? Now, is it the risk they are managing in portfolio, is it reduced or not? In insurance, yes, in case of insurance. Diversified, yes, or from the enterprise point of view, is diversified, so in some sense it's controlled, but What I mean, from the policyholder's perspective, when you insure yourself, are you reducing the risk or not? You are not reducing your risk. If I sign a contract against risk of death, unfortunately, I will die with exactly the same probability. Uh, if I insure my car against risk that this car is stolen, the risk should be and would be exactly the same depending on how honest is my behavior. I mean, if I'm not insured, I will take care of, of my car. I will always close it. I would never leave the keys inside and so on. Uh, but if I can be more easy in the in managing my risk, this risk specifically, if I'm insured, I would say, well, I'm insured if they stole, if they stolen, they will be paid. And apart from that, if your car is stolen, the first thing the insurer will ask you are the keys. So if you don't have both keys, insurer will not pay. It's better to know because you know they evaluated your risk, they estimated the risk that your car is stolen, but the car without keys, car with keys, the probability is much higher, of course. So you should have paid much more as premium. But that's another story. So actually, you remember I proposed you a graph where you have a series of losses. This is a qualitative abscissa, so you have just here different contracts. No losses here, no losses here, losses here, no losses, losses, and so on. Big loss. If you are not insured, everybody will pay its own losses, will suffer from its own losses. And if there is a threshold over which is easy to fade, this and this and this will fade. In case of insurance, instead, everybody will pay exactly the same because they are in a homogeneous portfolio. So everybody will pay this, 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 and this. Nobody will fail, of course, because all of them they can afford. Well, maybe it should be more because otherwise that's odd. Let's add a few contracts like this, few more contributors, let's say. So they will also pay. No one will fail, and this is just something which is socially precious because the stability is granted. No enterprise is failing, no workers at all, no unemployed people, no consequences. And what has to do with risk and risk transformation? Has been transformed the risk? No, because the probability will be also the same. What's happened is that the risk has been redistributed. has not been transformed, has been redistributed. Because this one, for instance, this one, for instance, this, and this, this, and this, and no, this not. They couldn't know in advance, but if they, if they wouldn't insure themselves, they wouldn't pay anything because you see, they didn't suffer ex post. You can see that they didn't suffer from any loss. So what's happening here is that instead of let the few people pay big losses and all the others save themselves, nobody would save, but everybody would pay, but just a small amount. That amount is the amount of premium. And this is better, not the redistribution of risk, but this is a redistribution, better. This is a redistribution of the bad outcome of risk. And what is the bad outcome of risk? Is loss. So this is a system. Insurance is a system to redistribute the bad outcome of risk. So you see there's a very big difference. Reduced risk for depositors. You cannot say the same here, reduced risk for policyholders. All policyholders' risk is the same. But once they suffer from a loss, the insurer will pay. So what they have to pay is just the premium. Just the premium. Now let's go back to the slides. So stop sharing here. We did this, value at risk, okay. Interest rates, you remember this? And also you remember the monetary policy. Well, so risk is everywhere. We talked since the very beginning. Risk is the crux. It's a crucial topic here. It's very important. And specifically risk measuring and risk management. We saw what is it, how to define, how to identify, how to measure. Now, why to manage and how to manage. Why to manage, you already know. That's a matter of making or saving money depending on what kind of risk. Making money or saving money. Making in case of speculative, because you can make money with speculative risk by exposing yourself to a risk, financial risk. You cannot make money as a consequence of being exposed to pure risk, because pure risk is a downside risk, and all that you can do is to save yourself. And if you finance risk instead of controlling, you save yourself, but you are still to pay to save yourself. So you are still to make explicit the cost of risk. Speculative and risk, speculative and pure risk, you know the difference. I told you the first day. And what you can do with risk, you can ignore it. I mean, you couldn't decide that you don't take care. But it still costs. You could be a risk seeker, in case of speculative risk, you can try to avoid, but that's not always an option, but sometimes you can avoid. For instance, for an enterprise, new risks in a business, new risks coming from a new business, the business that you started last year, that you added to your portfolio of different investments and so separate business of your enterprise, which is not which proved itself being not profitable, you can take off in part or at all, and this is different. Elimination, you can eliminate 100%. You can reduce, diversify, you can control, you can share, risk sharing, like the case of co-insurance. So companies taking underwriting a big risk, transferring financing, case of insurance, in fact, and so on. How? So why was a matter of making profits or maximizing profit, making or saving money. Now it's maximizing profits or minimizing losses through the risk management process. And risk management process I already explained to you. We are just looking at a more specific framework, which is this one. You have to establish the context, the strategic context, the organizational context, so depending on the characteristics of your own enterprise, or again, industrial or financial, like in case of the enterprise, what we are interested to. Risk management context, and you have to identify internal and external stakeholders. Establish the context is enough. Then risk identification. We saw risk analysis, which means risk analysis, you have to look at your vulnerability degree or resilience, you prefer, as I say. Not the same, but it's the same is the outcome of this analysis, of this investigation, are the same aim. So you have to determine the consequences on your business, or your business. So this is just about you and the probability. So consequence is L, and probability, likelihood is probability. Then you have to rate risk. Rate risk means that you have to locate risk in your acceptability chart, and you have to calculate the distance from the origin of the axis, which is a proxy for the size of this. Par is higher probability and or high severity. And then you have to decide which ones you would accept and which ones you would reject. Then you choose the mix of instruments, you tailor your coverage, and you test the effectiveness of your choices in order to modify, to adjust, monitoring and to adjust. To monitor, you have to monitor and to adjust in case. Then communication and consultation is not particularly important for that. Risk identification, analysis, evaluation, treatment, and monitoring. Monitoring and review. Review means feedback. You take into account feedback and change mix of instruments. The actors. Did I show you the actors before? I'm not sure, but let's see here. Well, you have corporations or enterprises, you have banks, and the other derivatives originators. We'll wonder what I mean in a minute. Insurers, central bank, reinsurers, and market. So market means depositors, investors, and insurance policy holders. So individuals, in other words, individuals. This can be, we can adjust this scheme. Usually, whatever was the scheme that you approach, when you deal with banks or financial intermediaries, then financial institutions, but let's say financial intermediaries, they are in the middle, intermediary in the middle between, let's avoid to say again, in the middle between. Who are on the right hand and who are on the left hand. But yeah, in the middle. Now let's try to redefine this scheme by having the enterprise in the middle, because we are interested to also to look how the risk is moving, in the market, how the money is moving in the market. They are two very important details. They are not details. They are two very important investigations we have to do. So let's say, if we may recognize, we'll do later on the risk and the money racetracks. How the risk is moving through the market, how the money is moving through the market. So we have the enterprises here, then the banks here, and the insurers here. So we have, along this line, we have the financial intermediaries. Then we have here central bank, and we have here reinsurers. Who has? Am I forgetting? Is it missing anybody? Well, apart from the enterprises, I'm missing all the counterparts. Apart from the enterprise, because they are counterparts of financial intermediaries. But who else? Depositors, investors, then policyholders. In one word, the market. So which is the meaning of these arrows here? This, this, this. this direction. I mean, they had the risks that the enterprises are forwarding to the banks first, then central bank. It's not exactly like this, but it is in case of insurers and reinsurers. Different kinds of risk. So enterprises, you remember, no banks, no business, no insurance, no safe business. Then what they are doing, the enterprise, they are taking off all risks. On this side, at the bottom here, with the insurers, they are taking off pure risks, and on the top, they are taking off credit risk. And they are generating them themselves. They do identify. They are identified with. Over the latest decades, this is something that I've been explaining also in the other class because they are more focused on that. But it's still something that you have to be aware because it's part of the story when we speak about securitization. The role of banks and insurers has changed a lot. Once it was very clear who was in charge of what. So banks were in charge of providing money to the enterprises, and insurers were in charge of providing protection. Then there has been what we call the financialization process, so some sort of confusion. They say convergence, but that's not a convergence, not just a convergence, it's a very big confusion between these roles. So that insurers, they started to produce financial products, no more actuarial products, the traditional ones, but financial, like insurance linked, unit linked, in general, the insurance linked securities, so-called insurance linked securities. And they also started through securitization to generate new securities. This is the famous asset-based securities, being the assets, the bad loans of banks, and the unwished big risks of insurers. So also banks and also insurers, they started with the help of SPVs to transfer risk. Instead of risk warehousing, we say financial management of risk. So market management. Also, this risk then has been given to the market. Let's say the investors, but there are some intersections between these categories. You see, you can be at the same time. You can be a policyholder, an investor, a depositor. You will, most cases. So the question is here. It seems that over the latest few decades, whole risk is flowing to the market. So once we had several kinds of specialized, in your book, special nets of financial intermediaries, and the theory, money due, credit due, they have this attitude and this other attitude, they are the only ones capable to manage your asymmetric information, they are special, they can do that, I cannot. And now, what's happening? Once it was like that, now Now all this risk is flowing to the market. And what are the market? The market are individuals who have not experienced technology, budget to diversify. They suffer from asymmetric information because they don't know what really, they don't really know what they are buying. And so in your book, incumbent on your book, on your chapters, there is the global financial crisis, the story of financial crisis, and it's not updated to this week. But if it was, you can find also the current crisis, the COVID-19 and now the war. So there is something which is not working at the best. And this is part of our focus. Let me say something before we close. I received an email or a message, I don't remember, well, it's not important. It was before I start. Not important who is in. Maybe it's now connected. It was about, it's a professor. I'm in trouble because I cannot find what you're saying is what you are sharing, slides and so on Tuesday sessions is not enough to prepare the exam. So because you didn't upload anything in the Moodle, not yet, in fact. Is not enough to prepare the exam. Yes, of course, it's not enough at all. First, because this is the third week and we didn't finish. Second, because they are just slides. You have a book and you have to follow the book. Third, you know, I told you at the beginning that if my task was just to read the book, I should think that my role here is useless. Because if you are capable, if you can read by yourself. So that's why it's not yet enough. You can try at the end, you can try to pass the exam just looking at the slides, at the materials I will upload in the Moodle, because I will do, of course, but much better if you keep in mind that you have to go through the book. And also many technical issues we are still to face. You know, how to manage risk, all the asset liability management, and the gap, and the market risk, and how to manage and duration and convexity. Of course, this is not enough because they are not finished. So to conclude, no worries, because at the end you'll be in a condition, if you follow me and you have a look, and not just have a look at the book, you'll be in a condition to be happy with the final outcome of this exam. I have no interest to kick off you when you come to the session. Thank you very much indeed. Tomorrow it will be a WhatsApp session, in fact, to share slides. I will not be here, but I will be connected, and I will be back on Friday in presence. Thank you very much indeed, and goodbye. Have a nice evening.